What's up everybody, Steve here. Today I want to talk about an article from the Wall Street Journal that just hit a couple of days ago, basically stating that mortgage payments haven't been this affordable since 2008. So let's go ahead and dive in. So the article goes on to say home prices are rising at a record pace, but incomes aren't keeping up, which is making home ownership less and less affordable. The median American household would need 32.1% of its income to cover mortgage payments on a medium price home. Supercharged home prices in markets across the country are canceling out the impact of moderately higher incomes and historically low rates. Now check this out. Median home prices were $342,000, up 23% from the year before, and median incomes were $67,000, up only 3%. So basically that's just telling you right there that essentially incomes are not keeping up with the increase of values of homes, making it less affordable for people. It goes on to say declining affordability will have the biggest impact on buyers shopping for their first homes, who will have to sign up for larger monthly payments, buy less desirable homes, or step back from the market altogether, economists said. And I can tell you right now, being a broker in Southwest Florida, there's a lot of people that are stepping back. They are on the sidelines, just kind of down and out. They were in a rush, in a push, basically competing with a lot of other buyers, a lot of these iBuyers as well, getting outbid. They're extremely frustrated, and a lot of these buyers elected to just basically lock in an annual lease. During the early months of the pandemic, home prices became more affordable. Interest rates fell, and home prices, while still rising, weren't accelerating as such a fast pace. And I completely agree. When the pandemic first hit, pretty much everything just halted. Everything was just like, what is going on here? So sales dropped off, everything kind of dropped off and came to a standstill. And then once things started to, once the dust kind of settled, people started to realize, okay, you know what? Rates just dropped again. Let's go ahead and get back into the market and buy homes. And the people that did buy homes immediately after the pandemic first started, they definitely got into a better equity position because prices were still affordable. Goes on to say, but then many families, after sitting on the sidelines for a few months, raced to buy homes, eager for more space or to move out of crowded cities. The fierce competition sent home prices soaring. Affordability began to decline. It's like October 6th or 7th right now, and it is blazing in Southwest Florida. At the start of 2021, Americans needed about 29% of their income to cover a mortgage. That rose to about 32% by July. Now you might be thinking, from 29 to 32%, it's only a 3% swing. You know, that's a lot of money for a lot of people. And even right now, you know, we just had a meeting in our office talking about the rising insurance rates, and I'm going to do another video on that because a lot of people that bought homes that were, you know, kind of paycheck to paycheck, maybe they got in with an FHA mortgage, 3.5% down. You know, for one thing, their real estate taxes will adjust to the new assessed value, so they have to anticipate real estate taxes increasing, of course. But a lot of people were not anticipating interest rates, or they were not anticipating insurance rates to increase as high as they have. And we have one story that came into our office recently, and this girl bought a $220,000 house, you know, affordable housing, and her new monthly payment with escrows, meaning insurance is in with the mortgage, went up $120 a month, and she's freaking out. And unfortunately, I don't think she's going to be able to pay for that, and we might have to go ahead and list that property for her. Any affordability that mortgage rates lended has pretty much been erased at this point, said Daryl Fairweather, chief economist at real estate brokerage Redfin. Redfin is a really good leader in terms of real estate data, and they really have their thumb on the pulse when it comes to really what's going on in the real estate markets. Home buyers have noticed as well. About 63% of consumers surveyed in August believed it was a bad time to buy a house. According to Fannie Mae, that was up from 35% at the same time last year. people, as mentioned, they were frustrated. They were getting outbid. They would bid on 10, 20, 30 different homes in Southwest Florida anyway, getting outbid. They're frustrated, and they're recalculating what it costs for them to purchase a home. And even with the low interest rates, but it's offset. If you have extremely low interest rates, but the purchase of that property is $100,000 more than what it was a year ago, it's gonna be a wash and or be completely upside down in terms of the interest rates looking good for the actual purchase of that property. And right now, I talk to a lot of people, and they're asking, should I buy a home right now and stuff like that. And if it's an investment property, I just say, make sure you run your numbers forward and backwards. The interest rates being this low are enticing, but you have to make sure that that property cash flows. And then if you're buying a home for yourself, I would just make sure that, for one thing, you guys are probably going to keep that property long term, because I think that the market will shift. And I've done another video about, if you buy a house for say $300,000 and you put 3.5% down and you sell that property for the same purchase price that you paid, after all closing costs on the back end, you're gonna have to cut a check at closing to unload that property. So if something happened in your family, a death, divorce, disease, you had to relocate and you had to sell that property in a flat market for basically what you paid for that, you might be upside down, and unfortunately might turn into a short sale situation. So I would just say be very cautious of buying real estate in this market. And look, if you're going to buy a property and you're going to be there and lock in a good 30-year fixed rate or a 15-year fixed rate, and you're going to hold on to it, fantastic. Another thing too is, run it as if if you had to move out of that property and you had to rent it out, will it cash flow for you as well? Because you could always flip that into from a primary residence into an investment property as well. So I would suggest just running the numbers as many ways as possible. If you did in fact had to move out of that property, are you in a good equitable position to sell it a year from now if the market goes down, say 10%? Or if you had to move out and you had to flip it into a rental, is it going to cash flow for you guys? Anyway, I appreciate every subscriber on this channel, and if you got any value out of this, I appreciate a thumbs up. And if you're not a subscriber and you want to learn more about real estate, personal finance, then maybe this channel is for you guys. Thanks a lot for being here.